So let's talk about what the Fed is doing. I mean, the latest chat out of the Fed is, a much bigger move up. Of course, they're trying to talk it up, and the yield curve is responding, and so we're approaching 3 on the 10-year, 3%. Bonds have done very poorly as a counterbalance in portfolios to what's called equity market volatility. It's just not working. And I guess what people should have realized is when bonds get to yields near 0, 1%, there's really no more cushion they can provide. It's at best going to do nothing as opposed to being negatively correlated. So we've seen the correlation for bonds to equities go positive quite significantly. We've seen the downside get pretty extreme. We've got a bar chart here that's going to show people the degree of downside in the bond market. My producer pulls up the right one. There it is. What it shows is that bonds are down 9.5% this year, not helping very much when equities were down 12. OUSA was down 10. So OUSA was about the same as bonds. Not perfect, but certainly not risky, really materially riskier than the bonds. And so people are talking about adjusting portfolio structure and not really using bonds as in the way that they used to. So we can move back from the slide here and just talk a little bit about what you're hearing from people on how they're structuring portfolios. You've got advisors that have to have a certain amount of fixed income. They don't want to have long-term high duration government bonds that lose 9.5% when the markets sell off, equities sell off. What do you hear about people considering or doing on the fixed income pieces of their portfolio?
Yeah, it's definitely been a really, really challenging scenario. And if you think just, really broadly speaking, you have on one side this really high inflation number where different types of assets work well to combat that. Things like gold, things like commodities. And then you have on the other side, rising rates where different types of assets will work well, like your value stocks, like your dividends. And you have these two things happening at the same time. And what do we know? We know that the Fed is committed to bringing down that inflation. That's not going to happen until they slow down the economy, which means slowing down the market itself. So it's really a tough place to find what is actually going to work. So if you look just from where people are putting money to work, trying to figure out how to survive this moment in history, is you see a ton of money going into dividend payers, which is a total income play. It's an equity play. But if bonds and stocks have the same, type of risk at the moment, why not take that risk in the equity side and pick up dividend yield? So because bonds and rising rates are just a terrible match, as you know. So we're seeing a ton of money go to that, but we're also seeing the classic inflation plays, a ton of money going to commodities, a ton of money going into gold specifically. So it's been kind of some of these classic ways to try and adjust for that. But what's been fascinating is just recently, in the last 2 weeks, I'm starting to read and hear people talk way more about just don't give up on your bonds. Just stay the course. So there's just a starting change in sentiment. And we've seen treasuries rally a tiny bit recently. So it's kind of funny how narratives are everything in the markets. It's all about, where we go from here. And so I'm just wondering if that's going to stick. Some of your classic long-term buy and hold investors are all like, don't give up on your bonds. Everybody gives up on their bonds when things go bad, and then they regret it. So it's kind of, people have a hard time trying to figure out what to do with fixed income. It's really, really challenging.